Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about FALCON'S Beyond Global Inc. annual report. FALCON'S Beyond Global Inc. offers a diverse range of services and businesses that cater to the entertainment industry. At its core, the company provides master planning and attraction design for various projects. This includes experiential entertainment, content production, and interactives, which are essential components in creating immersive experiences. In addition to these services, FALCON'S Beyond Global Inc. also offers software solutions, media and audio production, project management, and experiential technologies. The company is involved in the development of attraction hardware, procurement, and sales, making it a one-stop shop for entertainment companies. Furthermore, FALCON'S Beyond Global Inc. has expanded its reach by developing, owning, and operating resort hotels, theme parks, retail spaces, dining establishments, and entertainment venues. This diversification allows the company to offer a comprehensive range of services that cater to different aspects of the entertainment industry. FALCON'S Beyond Global Inc. market capitalization of $1 billion is materially smaller than most of its industry peers of roughly $4 billion. FALCON'S Beyond Global Inc. trades at a higher price-to-earnings ratio of 408 times and a higher price-to-book ratio of 49.35 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 64% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified by examining a company's financial performance. According to the annual report, several key factors contribute to this outcome. Revenue growth is often driven by an increase in sales volume and market share. Companies that successfully expand their product offerings, enter new markets, or improve their distribution channels tend to experience higher revenue growth. Additionally, companies that invest in research and development (R&D) can create innovative products or services that capture a larger share of the market. On the other hand, revenue decline is often caused by decreased sales volume, increased competition, or changes in consumer behavior. Companies that fail to adapt to shifting market trends or neglect their product offerings may experience a decline in revenue. Furthermore, companies that are heavily reliant on a single customer or supplier may be vulnerable to disruptions in their supply chain. Ultimately, the success of a company's financial performance depends on its ability to balance growth with stability and adaptability. By understanding these key drivers, businesses can make informed decisions about investments, resource allocation, and strategic planning. The net income of a company underwent significant fluctuations between 2024 and 2025. Initially, it decreased by $143,169 from $149,481 to -$6,312. However, when comparing the same period in both years, the net income increased by $20,080 to $16,959. This inconsistency can be attributed to various factors. One major reason for the decline in net income was impairment losses recognized for investments in equity method investments, amounting to $8.3 million. Additionally, unexpected consequences of business model changes, such as the closure of Kathmandu Park Doctor and Tenerife sale, contributed to the decrease. The company's operating costs also increased due to its expansion across 3 distinct business lines. The profit margins likely decreased despite an increase in revenue by 81.51. This can be inferred from the significant decline in net income compared to the increase in revenue. Furthermore, the loss of key clients, particularly QIC, which accounted for 60% of FCGS revenue in 2025, also had a negative impact on profit margins. In conclusion, the changes in net income and profit margins can be attributed to a combination of factors, including impairment losses, business model changes, increased operating costs, and loss of key clients. These factors collectively contributed to the decline in profit margins despite an increase in revenue. The company's financial performance reveals a concerning trend of generating negative operating cash flow. As evident from various pages of the summary, the company has experienced significant losses and negative cash flows from operating activities. Specifically, it is reported that the company generated a net loss of $6,312 and an adjusted EBITDA of -$17,327 in 2025. Furthermore, operational losses and negative cash flows from operating activities were also observed for the year ended December 31, 2025. These indicators collectively suggest that the company is struggling to generate positive operating cash flow, which raises concerns about its financial stability and sustainability. The company's debt level and interest expenses do not appear to have undergone significant changes. The total working capital deficiency remains at $18.1 million as of December 31, 2025, indicating a consistent level of debt. Furthermore, the interest expense has been reported in multiple instances with varying descriptions, but none show a substantial change. In fact, some reports indicate a decrease in interest expenses from $1,898 to $3,384, while others suggest an increase by the same amount. This inconsistency suggests that the company's debt level and interest expenses have remained relatively stable. The performance of Falcon's Creative Group, FCG, and its subsidiaries was a mixed bag. On the positive side, FCG excelled in terms of physical presence at industry trade shows, active participation in influential organizations, and robust digital marketing efforts. This strong showing contributed significantly to the company's revenue, with 45% coming from shared services to FCG. FCG's sister company, Falcon's Beyond Brands, FBB, also showed promise by growing its online presence on LinkedIn and YouTube, which helped drive sales of rides and attractions. However, not all segments fared as well. Falcon's Beyond Destinations, FBD, lacked specific information about its marketing performance, leaving room for improvement. Furthermore, the company's international markets posed significant risks due to varying degrees of social, political, military, and economic instability in certain regions. This was compounded by regulatory and legal risks in countries like Saudi Arabia, underscoring the need for careful navigation of these complex environments. Management's outlook for the company is cautious due to significant uncertainty surrounding the realization of deferred tax assets. Despite reporting a net loss before income taxes, management has maintained a full valuation allowance on these assets. This suggests that the company may face challenges in generating sufficient taxable income to utilize its existing tax benefits. The company's financial performance was impacted by impairments on investments in FCG and Carnival, as well as a net operating loss carryforward of $208,000. Management has acknowledged related party transactions with its parent company, FBG, which may raise concerns about the company's independence and decision-making processes. In terms of strategy, management appears to be focused on long-term growth, as evidenced by the share-based compensation plan that will vest over a 5-year period. The company also continues to invest in research and development through related party transactions with its parent company. However, the assumption of a warehouse lease as part of the OES acquisition may indicate a focus on operational efficiency rather than expansion. Overall, management's outlook suggests a cautious approach to financial planning, with a focus on maintaining flexibility and minimizing risk. The company appears to be prioritizing long-term growth over short-term gains, but faces challenges in generating taxable income and realizing deferred tax assets. The company has made several significant acquisitions and divestitures over the years. In terms of acquisitions, the company acquired assets from OES related to advanced ride systems and technologies on page 14. On page 19, it was announced that Falcon's Treehouse, LLC and its subsidiaries were combined with Kathmandu Group, LLC and Fun Stuff, SL in April 2021. Additionally, a business combination with Fast Acquisition Corp. II took place in October 2023. The company also made strategic investments, including one by Kitia Investment Company, QIC, on an unspecified date. Furthermore, the acquisition of OES assets was completed in May 2025. The financial impact of these acquisitions can be seen on pages 61 and 89, where FCG and PDP reported significant increases in value as of December 31, 2025. In terms of divestitures, the company has disposed of several assets. On page 19, it was announced that the Sol Tenerife Hotel was sold, while Carnival was wound up. The company also terminated its license with the Hershey Company. On page 22, the liquidation of the Carnival joint venture commenced. Finally, on page 29, the company was forced to divest assets in Saudi Arabia due to changes in laws or regulations. The company's dividend policy is a unique blend of traditional and non-traditional methods. While it has not paid out cash dividends, it has issued paid-in-kind dividends to shareholders on 2 occasions. Additionally, the company declared a stock dividend, issuing an extra 0.2 shares per share in December 2024. In terms of share buybacks, the company has been active in this area as well. It made distributions on its Series B preferred stock by issuing additional shares rather than paying out cash. Furthermore, the company bought back shares for $0.6 million in settlement in 2025. Supply chain disruptions pose significant concerns for business operations. The extracted summaries reveal several concerns regarding supply chain disruptions that could impact business operations. Delays or cost inflation in the supply chain and third-party vendors required to develop resorts and parks are potential issues, page 22. Furthermore, changes in trade policies, such as tariffs or restrictions, may increase costs, delay development timelines, disrupt supply chains, and limit market access, page 30. Additionally, cyberattacks pose a significant threat, which could have a disruptive effect on the business, page 37. These concerns highlight the potential risks associated with supply chain disruptions. The impact of these disruptions can be far-reaching, affecting not only the development process, but also the overall success of the business. It is essential to address these concerns and develop strategies to mitigate their effects. That concludes the financial summary for FALCON'S Beyond Global Inc. Feel free to comment below, and I will be happy to answer them when possible.